The US mortgage market just collapsed again in what is a scary sign for where the housing market is heading in 2024. It signals that home prices need to come down and points to a lot of incoming layoffs for the real estate industry. This is a mortgage market decline that is breaking historic records and something that people really need to start paying attention to. So we just got updated figures for the Mortgage Purchase Index by the Mortgage Bankers Association, showing that the index just slumped 10% on a year-on-year basis to 138. Now this marks a continuation in the rapid decline in mortgage applications, now down a whopping 60% from the levels that were seen in early 2021 and now at new historic lows that have not been seen since back in 1995. We are now even lower than the bottom that was reached in the aftermath of the global financial crisis, in which we of course saw the entire housing market collapse. Now what this shows us is that more and more prospective home buyers are continuing to stay away from the market and in many cases are being forced to stay on the sidelines because of how unaffordable purchasing a home is right now. This is perfectly demonstrated by the plummeting pending home sales index, also dropping to historic lows, showing that people just cannot afford to buy a home right now. Mortgage rates remaining at sky-high levels is of course one reason why mortgage demand has been plummeting, and the 30-year fixed rate still remains just above 7%. Mortgages haven't been this expensive since the early 2000s, and they are more expensive than the mortgage rates that were seen at the peak of the global financial crisis. Now these sustained highs that we are seeing in mortgage rates wouldn't be a problem if they were offset by lower house prices. However, this is not at all the case. In fact, we have basically seen the exact opposite take place, with the Redfin median home sale price now at all-time highs of $434,000, while the Case-Shiller Home Price Index also keeps soaring to new highs. And house prices have even sustained growth since 2022 at the point that the mortgage rates started to rapidly climb, meaning that we have seen mortgage rates and house prices surge simultaneously, which is the complete opposite of what we have seen in history, where the two metrics have moved in opposite directions as house prices have risen while mortgage rates have declined. What we've seen recently, therefore, goes against this historic trend and is piling on extreme affordability pressure for home buyers. So with home prices across the US seeing explosive growth in the last few years, and with mortgage rates close to tripling in just a couple of years, we are seeing the Housing Affordability Index plunge to new lows. Now the housing payment to income ratio has also just jumped to 36.1%, meaning that households on a median income are now paying the highest portion of their income seen since the 1980s to sustain the monthly mortgage payments on a median priced home. And this house price to income ratio does paint a similar picture, showing that home price growth has far outpaced wage growth, and it does now cost 5.8 times the median household income to afford a median priced home, which is up massively from the 3.5 times in 1985. Now, with this balance between house prices, mortgage rates and affordability being so out of balance right now, it's no wonder that we are seeing the mortgage market in such rapid decline, with fewer and fewer mortgage applications being made. However, things cannot stay like this forever, and if we are going to see metrics and indicators revert back to more historical normal levels, then something is going to have to give, and there are only two ways in which we will see this happen. Either mortgage rates must fall or house prices must fall. Now, mortgage rates falling by any substantial margin is not looking likely, as recent inflation data has not been good and shows that CPI is staying stubborn and is not yet breaking below the 3% threshold, away off the 2% central bank target. And because of this, markets and financial institutions are predicting base US interest rates to remain high for the foreseeable future. Data from Bloomberg and Apollo shows that future markets are pricing in the Fed funds rate to only fall to about 4%, where it will then stay there until at least 2029. And Goldman Sachs research forecasts a similar picture, with rates remaining close to 4% years into the future, a level that we have not seen since 2007. Meanwhile, Goldman Sachs are also forecasting that 30-year fixed-rate mortgage rates will only decline slowly and gradually, and by the year 2026, they will still be well above 6% and close to 6.5%. Now this means that with interest rates and mortgage rates very likely to stay at these elevated levels for at least the next few years, the only way that we are likely to see affordability and mortgage demand increase is if we see considerable drops in house prices. And in fact, we are starting to see the early stages of a housing correction take place, with Redfin reporting that price drops have hit the highest level that they have been in 18 months, with high rates being the driving factor behind lower buyer demand. 6.4% of home sellers have cut their asking price during the 4 weeks ending May the 26th, which is the highest since November 2022 and has been on a continuous upwards trajectory since the start of 2024. And with less people in the market for buying a home, we are seeing inventory levels start to rise as well, and at the end of May there was 3.2 months of home supply available on the market. And this is more than the inventory at the same time last year, and does in fact continue the trend of inventory rising every year that we have seen since 2021. Compass co-founder and CEO Robert Reffkin told CNBC last month that 30% of the inventory on the market has seen a price drop, more than any time in the last decade, with supply up 16%. He did add, "It's a very different environment, we are now seeing more sellers than buyers." And if we look at this regional housing inventory data from the Calculated Risk Substack, we can see that there are some regions that are suffering more than others from a spike in housing inventory. Places that became hot and trendy to live in several years ago during the pandemic, such as Miami and Austin for example, are now seeing inventory levels surge year on year by 57% and 30.5% respectively. And there are a number of other regions seeing large spikes like this as well, and although many of these housing inventory levels are still below the 2019 levels, the 2019 housing market was a lot different to the one that we are in today, where house prices and mortgage rates were far, far lower. These spikes in housing inventory compared to last year are putting a number of these regional markets at higher risk of price declines, while the demand for housing remains extremely low. And with a whole load of newly constructed homes set to hit the market in the coming years too, we are likely to see even more upwards pressure on home supply. Now, newly constructed homes that are now completed and ready to be sold on the market are now above pre-pandemic levels and are the highest that they have been since 2009. Meanwhile, the number of homes that are under construction is also quite high relative to the historic average, and the number of homes for sale that have not been started just reached a new all-time high above the 2006 peak. And combining all of these new home builds that are being offloaded by home builders regardless of their current stage of construction, the figure is very high compared to the historic average. All of this new housing supply that will be entering the market is only going to contribute to putting downwards pressure on home prices and could be a recipe for disaster considering how weak the demand is right now. At the end of the day, the housing market is pretty broken at the moment, and the home prices that we are seeing today are simply not sustainable. We're not going to see people's wages magically increase massively, nor are we likely to see interest rates and mortgage rates fall drastically anytime soon, which means that all signs are pointing to a major house price correction in the near future, which will only be amplified by rising inventory and home builders offloading tons of supply onto the market. It's not just housing that is causing US consumers pain in this current economy though, and we have seen some big warnings being given from retail giants about changing consumer behaviour. My previous video goes into more detail on this topic, and you can check it out by clicking on screen right now. Aside from that, if you enjoyed the video, please be sure to leave a like and subscribe, as that does help out the channel a lot, and thanks a lot for watching.